The economic experts are warning of an impending global currency crisis involving the world's largest economies, dubbed the D7, Canada, France, Italy, Japan, Spain, the UK, and the US. These nations now carry government debt exceeding their GDPs, a situation exacerbated by high interest rates, a combination with no historical precedent. Here are some key points. First, debt and interest rates. The D7 borrowed heavily during the 2008 financial crisis and the pandemic when rates were low. Now refinancing debt at higher rates is straining budgets, with bond yields, for example US 30-year treasuries near 5%, escalating costs. Second, currency crisis risks. If investors lose confidence in a country's debt repayment ability, they may sell bonds and dump the currency, triggering devaluation. Past examples, for example UK in 1967, Asia in 1997, show how such crises can spread globally via trade and investor panic. Third, domino effect. A devaluation in one major economy, for example the US, could force others to follow to remain competitive, destabilizing global markets. The Eurozone is particularly vulnerable due to shared monetary policy, but uneven economic strength among members. Fourth, consequences for the public. Currency collapses would spike inflation, raise living costs, for example groceries, gas, shrink savings, and destabilize mortgages and retirement accounts. The IMF predicts slower growth and tighter budgets ahead. Fifth, limited solutions. Governments face grim choices: unpopular austerity, spending cuts, tax hikes, or inflating away debt by printing money, risking hyperinflation and loss of investor trust. Structural reforms are urgently needed but politically fraught. So, it can be concluded, the world is unprepared for a synchronized collapse of major currencies, which could dwarf past crises. The video urges viewers to monitor the situation and prepare, as market forces may soon force governments' hands.